Today I'm going to talk about factors impacting feeding cost of gain. When we look at feeding cost of gain, before we look at the specific factors, feed conversion, corn price, alfalfa price, and talk about other factors that might impact feeding cost of gain, I think it's important to step back and think about what impacts cattle finishing profitability. In addition to feeding cost of gain, the feeder to fed price ratio impacts cattle finishing profitability. And so I'm going to talk about cattle finishing profitability for a few minutes, and then we will turn my attention to factors impacting feeding cost of gain. So looking at cattle finishing profitability, first of all, let's define how we calculate cattle finishing profitability. A net return equals gross return minus feeder price, which is by far and away the largest expense to the person feeding in a feedlot, feeding a pen of cattle. The next item is feeding cost of gain, which is the cost of feeding the animal. That's pretty obvious. Typically, the feeding cost of gain includes a feed markup. If there's not a feed markup on feeding cost of gain, there's a separate yardage charge that would need to be added to this list of costs and subtracted from gross return. But here I'm assuming that the markup is included in feeding cost of gain. And so that's actually the cost of feeding the cattle in the feedlot. Finally, we have the interest cost, interest on the feeder, perhaps interest on the feed, but we have an interest cost. Typically, the interest cost, though it's important, does not vary that much because the interest rate hasn't changed that much during the last 10 years. I mean, we've had some variability in the interest rate, but not all that much. And so when you look at variability in profitability, you're typically looking at the feeder to fed price ratio, or what's the relationship between what I paid for the feeder and what I received in terms of fed cattle when I sold the animals, and what did it cost me to feed those animals during that 160 days, 170 days, which would be very typical days on feed. So we'll start with the feeder to fed price ratio. This is very obvious, but if an individual pays too much for feeders, it is very difficult to obtain a profit on a pen of cattle in a feedlot, regardless of how cheap the interest rates are and how low the feed costs are. And so if you don't buy them right, you're not going to have a very good return. Let's look at the average feeder to fed price ratio to get a handle on what's typical in terms of this relationship. The average feeder to fed price ratio using Kansas data has been 1.23 since January 2011, or the last 10 years. When the feeder to fed price ratio was more than one standard deviation above 1.23, which it sometimes is, I'll show you a graph of a feeder to fed price ratio here in a minute, net losses averaged $265 per head. That was the average. And so when you pay a lot for feeders and you don't receive a very good price after the 160, 170 days, you're going to have some pretty big losses. Now, obviously, nobody's expecting a feeder to fed price ratio to be 1.4, 1.5. What happens is you buy the feeders thinking that the fed cattle price is going to be at a certain level when you sell the cattle, but that doesn't materialize. Fed prices deteriorate, and so as a result, your feeder to fed price ratio is relatively high. Conversely, when the feeder to fed price ratio was more than one standard deviation below 1.23, and again, it can get fairly low, net returns averaged $122 per head, or we had a profit of $122 per head. Looking at a graph of this relationship since 2011, we see that it's quite volatile. The average is 1.23, but there's times when it's as low as 1 or slightly below, and then there's times when this ratio is well above 1.5, getting up into that 1.7 range in 2015 and 2016. So a lot of variability in this feeder to fed price ratio for steers. Recently, specifically in 2021, we've seen a feeder to fed price ratio that's below average, but what's really prevented us from having some really good returns is high feed costs. And so you have to look at the combination of feeder to fed price ratio and feed cost when you're looking at net returns. And so let's turn to the feeding cost of gain. There's several factors that impact feeding cost of gain, including feed conversion, which we'll talk more about here, average daily gain, how well do the cattle gain, days on feed, placement weight, type and quality of feeders placed, that's very important, obviously, corn price and forage price. We will focus on feed conversion, corn price, and forage price in the discussion below, because those are three of the primary items driving changes in feeding cost of gain over time. Before we do that, the average feeding cost of gain during the last 10 years, or since January 2011, is approximately $90.60. Feeding cost of gain has been above this average since March of this year. In fact, it's been over $100 here in recent months. And so, feeding cost of gain can be substantially above that average of $90. And it also can be substantially below when corn prices are relatively low. For example, we have strong performance, or we have low forage prices, or a combination of those things. So looking at feeding cost of gain over time, we see a recent spike in feeding cost of gain. We're getting up to levels that are somewhat similar to those that we saw in late 2012 and 2013, and certainly much, much higher than what we saw in 2020. 2020, the feeding cost of gain was relatively low because corn prices were relatively low because of what was going on with COVID-19. As corn prices started to increase last fall, feeding cost of gain started to increase quite rapidly to reach the current point right now. We're over $100 per hundredweight in terms of feeding cost of gain. Before we get into the factors impacting feeding cost of gain, which is really the essence of this discussion today, let's define some terms. Feed conversion is measured on a dry matter basis in the material that I'm going to cover here, the rest of this presentation. Corn price is the actual inventory price during the feeding period, taking from the Focus on Feedlot newsletter, which is the source of data related to feeding cost of gain, feed conversion, and corn and alfalfa prices. And so that's the source of the information that I'm using to look at factors impacting feeding cost of gain. Alfalfa price is the inventory price during the feeding period. And as I indicated earlier, cattle are typically placed on feed 150 to 175 days. And so it's the corn price and alfalfa price over that 150 to 175 days. The feed conversion is based on closeout data. So it also reflects the days on feed, type of cattle, and seasonality and other factors that I discussed earlier. So feeding cost of gain is sensitive to changes in feed conversions, corn prices, and alfalfa prices. There are other factors that impact feeding cost of gain, but these three factors drive most of the variability in feeding cost of gain over time. And it makes it easier to talk about if you're only looking at a few factors rather than 10 factors or more, because there's a lot of items that impact feeding cost of gain. Regression analysis or statistical analysis was used to examine the relationship between feeding cost of gain, feed conversion, corn price, and alfalfa prices using data for the last 10 years. And so let's take a look at those results. So the result of the regression analysis, where feeding cost of gain was a dependent variable and corn price, alfalfa price, and feed conversion were the independent variables. Each 0.1 increase in feed conversion increases feeding cost of gain by $1.20 per hundredweight. Feed conversion is very seasonal, and so just the seasonality alone is going to cause some variability in feed conversion, but also types of cattle. What was the weather like during the feeding period? Just a lot of factors will impact this feed conversion. So feeding cost of gain is very sensitive to changes in feed conversion. A 0.1 increase is not a very big change in feed conversion. Similarly, each 10 cents per bushel increase in corn price increases feeding cost of gain by 88 cents per hundredweight. A dime movement in corn price is not very big. It's not that uncommon to see over a several month stretch, like we've seen recently, $1 or more increase in corn price. And so obviously feeding cost of gain is very sensitive to changes in corn price. And really the corn price is responsible for the for the very sharp increase in feeding cost of gain that we've seen recently. It's the overwhelmingly the most important factor right now, driving increases in feeding cost of gain, or relatively high feeding cost of gain, or feeding cost of gain above the long run average. Alfalfa price is also important. Each $5 per ton increase in alfalfa price increases feeding cost of gain by 45 cents per hundredweight. Again, that's a smaller change than the other two, and it's probably not quite as important as the other two, but $5 per ton change in alfalfa price is not very big change. And so we can see some spikes, times when we see spikes in alfalfa prices where it really changes the feeding cost of gain, specifically increases the feeding cost of gain. As noted on the previous slide, feed conversion has a significant impact on feeding cost of gain. Its importance is not quite as important as corn price, but it is a very important driver of feed conversion. Feed conversion is influenced by days on feed, placement weight, type and quality of feeders placed, and seasonality. I want to talk just briefly about the importance of seasonality. And again, this is using data from the Focus on Feedlot newsletter from Kansas State University. And so the data is for Kansas, but this would be similar in other states that have feedlots. We see seasonality and performance based on weather, type of cattle placed at certain times of the year, placement weight. There's differences in placement weight during the year, whether the cattle are coming off grass. It's just a lot of factors that impact the seasonality of feed conversion. And this is what I'm trying to illustrate here on the next slide. And so when you look at closeouts early in the year, you'll see that feed conversion is quite a bit higher. Why? But with the winter months, during the winter months, we tend to have higher feed conversions, or not as good feed conversions as we have as the weather gets warmer. The lowest feed conversions occur for June, July, August, and September period. And that's because for most of that feeding period, we had fairly good weather. And so the feed conversions are relatively low during that time period. I would like to note that the average feed conversion over the last 10 years, using this data from the Focus on Feedlots newsletter, is right around 6.1. So that's the average. We're below average, during that June, July, August, September, and October period, and even November, and they were above average in the other months of the year. And just please note, this is based on closeout month data, not placement data. So just to summarize, I talked briefly about the importance of feeder to fed price ratio and feeding cost of gain to cattle finishing profitability. And then I took a closer look at the factors impacting feeding cost of gain. These factors include feed conversion, corn price, and alfalfa price. And feeding cost of gain is very sensitive to all three of those. In particular, it's extremely sensitive to changes in corn price. Each dime increase in corn price or change in corn price results in a close to a 90 cents per hundredweight change in feeding cost of gain. And so very, very sensitive to corn prices. More information is available on the website for the Center for Commercial Agriculture, agpurdue.edu/commercial-ag. We have more information related to cattle finishing. We've got information about feed costs for other animal species, as well as information in general related to production agriculture.